The world of investing is undergoing a major transformation, thanks to innovations like robo-advisors and automated investment platforms. These technologies have revolutionized financial planning and portfolio management, making investing accessible to anyone with an internet connection. By using algorithms and big data, robo-advisors offer personalized investment strategies at a fraction of the cost of traditional financial advisors, making high-quality investment management available to the masses. What are robo-advisors? Robo-advisors are digital platforms that provide automated financial planning services with minimal human involvement. The process typically begins with an online questionnaire, where users provide information about their financial goals, risk tolerance, and current economic situation. Based on this data, the robo-advisor uses sophisticated algorithms to create a personalized investment strategy and manage the portfolio. The main appeal of robo-advisors is their cost-effectiveness. Traditional financial advisors often charge high fees and require large minimum investments. In contrast, robo-advisors typically have lower fees and allow users to start investing with smaller amounts, democratizing access to quality financial management. The role of algorithms and big data. Robo-advisors rely on modern portfolio theory and advanced algorithms that help balance risk and return. These platforms process large data sets and use this information to predict market trends and adjust portfolios automatically. Unlike human advisors, who can only work with limited data, robo-advisors analyze vast amounts of information in real time, ensuring portfolios are continuously optimized. Benefits of robo-advisors. Transparency is one of the standout benefits of robo-advisors. Users can track their investments in real time, seeing performance, asset allocations, and fees through easy-to-use apps or dashboards. This transparency helps demystify investing, especially for beginners who may find traditional financial services overwhelming. Additionally, many robo-advisors use passive investing strategies, which are focused on low-cost, index-based investments. This method has been shown to outperform more active strategies over time. By reducing trading frequency and keeping operational costs low, robo-advisors are able to minimize fees, which is a significant advantage for investors. Challenges and limitations. While robo-advisors are excellent for individuals with straightforward financial needs, they do have limitations. They lack the personalized, empathetic guidance that human advisors can offer for more complex financial situations, such as estate planning or navigating major life events. Another challenge is data security. As these platforms rely heavily on digital infrastructure, users' financial data can be vulnerable to cyber threats. Ensuring robust cybersecurity is crucial for protecting client information. The future of robo-advisors. Looking ahead, the potential for robo-advisors is vast. As AI and machine learning evolve, these platforms will become even more sophisticated, offering more personalized advice tailored to individual life changes, such as buying a home or starting a family. Robo-advisors are reshaping the financial landscape, making investment management more inclusive and data-driven. As these technologies continue to advance, they will empower more people to take control of their financial futures, creating a smarter, more accessible world of investing. Segment 1. The impact of technology on traditional asset management. One of the most significant changes is the accessibility of investment platforms. Thanks to the growth of online resources and mobile apps, individual investors now have unprecedented access to financial markets. These platforms offer lower fees, greater transparency, and more information, making high-quality financial advice available to a broader range of people. Technology has also enhanced how asset managers analyze data. AI and machine learning now allow firms to sift through vast amounts of information, identifying patterns and predicting market trends with incredible speed and accuracy. This helps portfolio managers make more informed decisions. In turn, it gives them a competitive edge, enabling them to respond faster than ever to market changes. Another key development is the rise of algorithmic trading. These automated systems execute trades based on predefined criteria. As a result, traditional asset managers are now being pushed to integrate these technologies. On the client side, robo-advisors are gaining popularity. These digital platforms provide algorithm-driven portfolio management with minimal human involvement. They assess a client's risk tolerance and financial goals, then create and manage a personalized portfolio automatically. For traditional asset managers, this shift means that services now have to be delivered digitally, while still maintaining the personal touch that clients expect. In addition, technology has improved transparency. Regulatory technology, or RegTech, helps firms navigate complex regulations more efficiently, automating compliance processes and improving accuracy. Clients also benefit as they now have access to real-time information on their portfolios, fees, and performance. However, the move to technology does bring some challenges. One concern is the commoditization of investment management. As robo-advisors and algorithmic trading become more widespread, the value of human advisors becomes harder to define. Traditional asset managers will need to find new ways to demonstrate their unique value to clients. Cybersecurity is another major issue, as more digital platforms mean greater risks to client data. Asset managers must invest in robust security measures to protect their clients' financial information. Segment 2. Customization in personal finance management. Moving on to personal finance, technology is also transforming how individuals manage their money. There's a growing demand for more customized financial solutions, and technology is stepping up to meet that need. AI and machine learning are at the heart of this transformation. Personal finance apps now analyze spending habits, income, and financial goals, offering real-time, personalized advice. For example, AI can track spending behavior and send alerts when you're close to exceeding your budget. This level of customization makes managing finances easier, more proactive, and tailored to your specific needs. Robo-advisors use algorithms to create personalized portfolios based on your risk tolerance and goals. These platforms automatically adjust your investments as market conditions change, ensuring your portfolio stays on track without requiring much intervention. Debt management is also benefiting from tech innovations. There are now apps that offer personalized repayment plans, helping people manage debt based on their specific financial situation. Financial service providers must ensure they protect this data and comply with privacy regulations, like the GDPR, to maintain customer trust. Segment 3. Integration of ESG factors in investment strategies. Let's talk about ESG. That stands for environmental, social, and governance. These are the criteria investors are increasingly considering when building their portfolios. The reason? More and more, investors recognize that companies doing well on these fronts aren't just good for the planet and society. They're also better positioned for long-term financial success. Let's break it down. Environmental factors look at how companies manage their carbon footprint, waste, pollution, and conservation efforts. Social criteria evaluate a company's relationships with employees, suppliers, customers, and the broader community. Finally, governance refers to how a company's leadership handles things like executive pay, audits, and shareholder rights. Why is ESG so important? Well, companies that ignore these issues may face regulatory fines, reputational damage, or operational risks, all of which can affect their stock prices. On the other hand, companies that prioritize these factors tend to be more resilient and adaptable as the world shifts towards sustainability. But here's the exciting part. Numerous studies suggest that ESG investments often perform as well, if not better, than traditional ones. Why? Companies with strong ESG practices tend to have lower operational risks and avoid costly fines or penalties. Plus, with investors increasingly leaning towards sustainable and ethical investing, demand for these stocks is rising. Technology is making ESG investing even easier. In the future, we'll likely see even more ESG-focused financial products, such as green bonds and sustainable index funds, giving investors more options to align their portfolios with their values. Segment 4. Transparency and fee structures. Next, let's talk about fee transparency in the financial world. As financial products become more complex, consumers are demanding clearer, more straightforward information about what they're paying for and why. Transparency means that all costs associated with a financial product are disclosed upfront. This includes any direct charges, like management fees, and potential additional costs, such as penalties or extra charges for account transfers. The goal is to avoid hidden fees that could surprise the consumer later. This shift is particularly noticeable in banking. Traditional bank fees, things like ATM usage or account maintenance, can significantly affect consumers' wallets. To compete, many banks have simplified their fee structures, some even offering fee-free banking for essential services. The investment sector is also seeing major changes. Online investment platforms and robo-advisors are moving away from complex fee structures and adopting simpler, more predictable models, such as flat fees based on assets under management. This contrasts sharply with traditional asset managers, who often have a mix of transaction fees, performance fees, and tiered charges that can be hard to understand. However, full transparency is still a work in progress. Segment 5. Predictive Analytics in Portfolio Management. This technology is revolutionizing how investors make decisions by leveraging vast amounts of historical data, machine learning, and statistical models to predict future outcomes. Predictive analytics can sift through massive data sets, market trends, economic reports, corporate financial statements, and news to identify patterns that could influence asset prices or market dynamics. For example, predictive tools can detect correlations between political events and stock performance, or anticipate how changes in commodity prices might affect exchange rates. What makes predictive analytics especially powerful is its ability to assess risk proactively. With predictive analytics, investors can forecast potential risks and opportunities before they arise, allowing them to position their portfolios strategically. This gives them a competitive edge in volatile markets. Another exciting feature is personalization. Predictive analytics can tailor investment strategies based on an individual's preferences, financial history, and risk tolerance. This ensures that portfolios are aligned with the investor's goals and increases satisfaction and trust in the investment process. Additionally, predictive analytics helps optimize asset allocation. By continuously analyzing market conditions, these tools adjust the portfolio mix to maintain the ideal balance between risk and return. Of course, there are challenges. The effectiveness of predictive models depends heavily on the quality of data. Poor quality or biased data can lead to inaccurate predictions, which is why ensuring data integrity is crucial. Despite these hurdles, the future of predictive analytics looks bright. As AI and machine learning improve, these tools will only become more powerful and accurate, further enhancing portfolio management and investment strategies. Conclusion: these developments are not just reshaping how we invest, they're helping to create a more sustainable, transparent, and efficient financial system.